Let's face it, at times we all want advice and guidance, especially when it comes to big decisions. And some of the biggest decisions you'll ever make in your life have to do with finances. An entire industry exists to provide this type of guidance, and investment newsletters, yes, are a big part of it. But beware, it's that time again to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies and new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional style investing to your portfolio. I'm David Scranton. You know, investment newsletters have been around for decades now, but questions have always been raised about their real value for everyday investors, particularly those focused mainly on saving and investing for retirement. We're to take a close look at investment newsletters and their industry today on the show. If you subscribe to or are thinking of subscribing to such a newsletter, we'll share some tips on how to know whether it's really a credible resource, as well as how to determine whether the advice that it offers is really appropriate for your personal situation. And as with anything else, there are the good, the bad, and the ugly elements to investment newsletters. And it's important to understand the differences if you're relying on them as part of your retirement strategy. Joining me today will be Adam Sharp, one of the founders of Early Investing.
You really need to do your research before you select a newsletter. It's very important that you really want to choose somebody that's very transparent with their numbers. If there's anything that looks suspicious with the charts or it looks like they're cherry picking the numbers, you want to dig into all this stuff and make sure that it's all legit.
Along with author and editor of the free newsletter, Economy and Markets, Harry Dent.
Real GDP's grown no more from 2007 to 2018 than it did from 1929 to 40 during the Great Depression, yet stocks are at massive new highs.
But right now, let's take a broad look at the investment newsletter industry, its overall popularity, as well as its track record of success. Now, if you don't read or subscribe to any of these newsletters, odds are that you're familiar with some of the most popular ones just by name, such as Motley Fool, Zacks, Kiplinger, etc. Most of these big-name newsletters are geared toward do-it-yourself investors who like to purchase, for the most part, individual stocks. Some have good track records in terms of their historical or their annual ratios of winning to losing stock picks. But be careful. At the end of the day, I believe that they're still promoting a financial strategy that is, by its very nature, risky. Risky for most everyday investors, those who are geared toward investing for retirement, and especially those who are retired or within 10 years of retirement. We'll be discussing this in just a moment, but first, I want to make it clear that the big name investment newsletters most people are familiar with are only the tip of the iceberg. The fact is, almost anybody can start and publish a financial newsletter. Usually the only criteria is that the author or publisher has some sort of history of forecasting success that he can point to as evidence of his so-called prowess. Now, while some may have actual professional credentials beyond that, in economics or finance, for example, others don't. They have the fact that they predicted such and such a stock or strategy would be a big winner back in 2006 or so, and they've been using that one piece of evidence as a sales pitch for their newsletter ever since then. And while their big winning prediction may sound impressive, keep in mind that they probably have a far greater number of inaccurate predictions that they simply fail to mention. Now, that's sort of the nature of the beast when it comes to forecasting stocks. A newsletter author may have made one or two good calls in the last 10 years and 20 bad ones. But thanks to those two winners, he's somehow qualified to give investment advice. So it's important to keep that in perspective also. And keep in mind that even when you do get a potentially good tip from a newsletter, its value may be significantly diminished by the time you make your particular trade. Why? Because a lot of other readers may be trading off the same information as well. While the first few might get a competitive advantage, after that the advantage starts to go away because the news has already been priced into the market and the price of that particular holding. By the time you act on it, the price of that holding's already gone up and it's no longer such a good buy. Here's the reality. While there is potentially a lot of money made from financial newsletters, the money usually comes from selling the newsletters, not so much from the authors taking their own advice. Think about it. Would someone who has real consistency in terms of making millions of dollars in the stock market need to be selling a newsletter subscription? In fact, I believe that's another reason why newsletter authors and publishers take a radical approach with their presentation and even with their advice. Why? Because let's face it, sizzle sells. And ultimately, the thing they're most interested in is selling newsletters. Now, although the market's still large, the number of investment newsletters out there has actually dropped since the 1980s and 1990s, which is when they first gained popularity. And that really shouldn't be surprising to any of us, since from 1982 through 1999, Wall Street was enjoying the single most successful bull market in history. At that time, everyday investors could potentially glean tips and advice from stock-based investment newsletters and follow them with far less perceived risk than exists in a market like today's. Now, that all changed, of course, when the dot-com bubble burst and the market fell by nearly 50% between 2000 and 2002, which, as you know, ushered in a new long-term secular bear market cycle, one that I believe we're still in. But here's the problem. As I pointed out in previous shows, is that many people remain stuck in the 80s and 90s mentally in terms of how they think about saving and investing. And we'll talk about this a little bit later today also. But even when taking that great bull market of the 80s and 90s into account, the question becomes, what kind of historical track record do investment newsletters really have? Well, the Hulbert Financial Digest tracked newsletters and their recommendations for a whopping 35 years. Of the 9 newsletters that still exist since their tracking first began, only 2 have beaten the market, while all the others have lagged the market. And what's more, at the time the Digest began tracking newsletters, it was tracking 28 of them, which means that over the years, 19 failed because they underperformed the market by such a great extent that they simply could no longer generate enough subscribers or advertising revenue to keep it going. When we come back, we'll talk more about some of the potential hidden risks and challenges of investment newsletters for everyday investors and some of the different categories into which these newsletters might fall into. And right now it's time to welcome our first guest, Harry Dent. He's the author of the book 0 Hour. He's also the editor of the free newsletter Economy and Markets, which you can review by going to harrydent.com. But last but not least, he's a friend of the income generation. In fact, Mr. Dent was our very first guest here on the very first episode of The Income Generation. Unfortunately, that was in New York City. This time around, we get to be interviewing with Harry Dent from his home in San Juan, Puerto Rico. Harry, thanks so much for being with us today.
Yeah, nice to be back, David.
Now, we talked earlier in the show, I don't know if you heard, about newsletters that have come and gone, that have had such bad recommendations that they've just died. But you are about to have a pretty big newsletter anniversary coming up in September of this year. Actually, you're going to be hitting 30 years of your newsletter, of publishing newsletters. So tell us, what do you think attributes to that success and that longevity in the newsletter industry?
Well, I think the biggest thing, because I know not a lot of other newsletter writers, a lot of people I admire and learned from, and other authors. The biggest thing I see is, we have our own methodology, and it causes us to see things other people don't think. But sometimes you don't see something, and the difference is when we don't see when something happens we don't expect with proven indicators, then we say, well, there must be something we're missing, and we just dig and dig and dig till we found it. Like in the 2000 crash. Well, we called that, but we said, no, this is just a bubble bursting. This is not the end. Baby boomers are still going to keep spending money. Then we get to the 2002 bottom, which we called, and we said, well, we got another 5-year run coming. And I said the Dow's going to go to 30,000 plus. Well, we were right about the run, right about the timing. It was going to peak in late 2007. but I over forecast, and I just, well, why didn't the second run do as well as the 90, the one before it, 95 to 2000? And it was the geopolitical cycle. I wasn't, the 9/11 had happened, and that changed valuations and the risk outlook in the world. So I came up with a great new geopolitical cycle over that. And so we just keep adding to our research and digging. I know a lot of other people, when something goes wrong, they say, well, if you adjusted it for gold prices or peanuts, we were really right. I don't do that. When I'm wrong, I think.
Yeah, that's data mining. You just have to kind of man up, as I know you do, and say, hey, I was wrong on this one call. It is what it is. But you haven't been right all the time. No one has, but you've been right more than you've been wrong. So, I know you're a Harvard-educated economist. But newsletters come from people from all walks of life. Do you think being an economist gives you a certain advantage over some others, perhaps, when writing a newsletter?
Well, my advantage is that I'm not an economist. I was a Harvard MBA. I studied business and marketing and management and strategy and accounting and finance. And I worked in, consumer-based companies, entrepreneurial companies, Fortune 100, Bain & Company as a consultant. I started in economics, and after 3 courses, I said, this is useless. Nobody understands economists. They disagree looking at the same facts, unlike the economists, scientists I study. And economists basically say nobody can predict the future past the next election. I'm like, well, why should I study economics? I want to be able to tell people what's going to happen 5, 10, 15, 20, 30 years, the rest of your lifetime and your kids' lifetime. And we've been able to do that by looking at things that are projectable. And the truth is, David, much more, the long term is much easier to predict than the short term. And the economy is far more predictable. I can tell your kids and grandkids when the next crisis like this, a kind of a bubble and depression crisis is going to be today. That's how predictable long term is. What's hard to predict is what Donald Trump's going to tweet or do tomorrow or next week, what the market's going to do next week. That's hard to predict.
Yeah, that's it makes a lot of sense. So it sounds like, in large part, you're attributing a good part of your success to being brutally honest with yourself, right? The old Jack Welch, be brutally honest with yourself no matter what. If you get it right or you get it wrong, doesn't matter. And also being more diverse in your background, more well-rounded, looking at it from all sides. I think that makes sense. Harry, we need to take a commercial break. And I know you're going to stick around for a minute. Thank you. And you stay with us also. We'll be right back here with much more from Harry Dent on the income generation. I'm David Scranton, and we'll be right back.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
As mentioned, most of the top financial newsletters are widely known, even amongst investors who don't actually use them. Some are also written by investors and market analysts with respectable credentials, and they do boast fairly successful track records. But there are some other important issues for everyday investors to consider. First, some newsletters are politically oriented, skewing most often to the right instead of the left. But although their economic ideas and opinions might be conservative, that doesn't mean that they're advocating conservative investment strategies. That has an entirely different meaning, which we'll discuss later in the show. In fact, very often, their politically conservative slant means that they've geared primarily toward a readership of very affluent investors, those with enough money to invest in the stock market in a way that gives them some level of control over those investments, regardless of the increased level of risk. Most everyday investors don't have that ability. For them, investing in the stock market is a very different thing, something we'll also cover later in the show. The fact that some of the top investment newsletters are geared toward wealthy investors becomes apparent when looking at the subscription prices, which oftentimes can be as much as thousands of dollars a year. Obviously, that means that if you're using it, the financial value you're getting from it needs to be measured against that lofty subscription price. And of course, any money spent on a newsletter subscription is money that's not invested in your portfolio. But even if you are subscribing to an affordable newsletter geared more toward everyday investors, there are still some other important points to consider in determining whether the expense is worth it. You may think it's better to pay only a few $100s for a newsletter subscription than to pay an investment advisor thousands in fees to manage your particular portfolio. But here's the reality. Whenever you try to cut costs by doing something yourself, well, as the expression goes, you get what you pay for. In other words, a newsletter, unlike the right advisor, doesn't know or care anything about you or your individual situation, which means any advice you're getting from it is generic, and that is risky. It's likely the difference between trying to find your way to a friend's house with directions that say go south versus a GPS that's designed to guide you through each and every turn. Obviously, your chances of getting lost are greatly decreased with the latter. And again, most newsletters tend to overestimate returns and underestimate risks. They play up their victories almost completely hide their failures. In the study that we cited earlier by Holbert Financial Digest, which again tracked newsletter performance over a whopping 35 years, one of the portfolios of a failed newsletter went down at a rate of 17.5% a year. That means that after 15 years, investors were left with less than 6 cents on the dollar. And yet the publisher of that newsletter still promotes himself as a reliable investment advisor and is reportedly still a very popular speaker at financial conferences. So please, keep all these factors in mind the next time you're reading about the latest hot stock tip or a new revolutionary trading strategy in an investment newsletter. Ask yourself, why is this analyst sharing this valuable information instead of just using his experience to make himself a boatload of money? Could it be he's really more interested in selling another subscription than in actually improving your particular financial situation? But also keep in mind that even if the tip is a good one, by the time that you actually act upon it, its value may already have been priced into the market. And as a result, it may no longer be such a great tip or such a great deal. And lastly, and perhaps most importantly, please keep in mind that playing the stock market is a very different thing for most everyday investors than it is for the kinds of big money investors who subscribe to the top tier investment newsletters. For them, the stock market might represent a true investment strategy. For most people, it's really more of a gamble, and one in which they're always overpaying for the stocks they purchase. Did I get your attention? Good, because if so, we'll be talking about that coming up in the next segment. Right now, let's welcome back our guest, Harry Dent. He's the author of the book 0 Hour. He's also the editor of the free newsletter Economy and Markets, which you can review by going to harrydent.com. Harry, thanks for sticking around.
Good.
Now, I know you and I think the same about one important thing, and that is we're at risk right now of having bubbles in many different places in our economy over the next few years, with the effects of quantitative easing, what I call economic steroids that have artificially pumped up. We've had this great asset recovery, maybe even more so than economic recovery, and eventually all that can turn the other way. Tell us your thoughts about that.
Yeah, the boom up until 2007 was baby boomers growing up, something we absolutely predicted 20 years before that. Technology, internet, personal computing moving mainstream on a predictable S-curve, another thing we predicted. But then we went into a downturn that started to look like the Great Depression, or what we call the winter season of debt deleveraging. And of course, we had big debt bubbles into 2007 and 8. But what had been quantitative easing, and all of a sudden the stock market's gone straight up in the slowest recovery in all of history. The stock market's gone, the real GDP's grown no more from 2007 to 2018 than it did from 1929 to 40 during the Great Depression, yet stocks are at massive new highs. Stocks have gone up because earnings per share have gone up 120% faster than earnings.
All the corporate
because
buybacks.
of quantitative easing and stock buybacks. Almost all the buying in stocks, net buying, has come from corporations buying their own stocks, and then you have governments and central banks buying their own debt and pushing down rates for everybody to zero adjusted inflation and allowing them to float massive debt and to fund that debt at very low interest rate. It's an entirely artificial economy. And this comes into the 2007 top was predictable. 2001 was when our geopolitical cycle reversed down and valuations went down. But this, we're hitting our most powerful long-term cycle, the technology cycle, which on a double cycle peaks every 90 years. And the anniversary of the 1929 top is coming about the same time as my 30th year anniversary for my newsletter in September 2019. So I'm saying this bubble is finally going to peak most likely late this year, early next year. Could even extend one more year because you know who wants to get reelected. Right. And probably will be sending checks in the mail on top of tax cuts.
And it's it's kind of hard betting against the Federal Reserve also, correct?
Yeah. But again, since it's artificial, you can only blow up a bubble so far. Bubbles are, and I hate to say this literally, I used to show a chart even 10 years ago comparing the Roaring 20s bubble with the Masters and Johnson orgasm study, male orgasm study, scientific study. And it fits perfectly in every bubble in the world today, whether real estate, commodities, stocks around the world, fits that model. And that model goes up and it gets more exponential. And then when it bursts hard. There is no soft landing.
So Harry, this brings me, in the minute we have left in the segment, this brings me to something you told us last time you were on the show. You said that, you know, every time it gets a little higher and then it gets a little lower. It gets a little higher, it gets a little lower. Based upon what you said, you kind of hinted toward the fact that the next low is likely to be maybe 50 to 70% down from where we are today.
More than that way? Yeah. That megaphone pattern, higher highs and lower lows, the next low would be at least 5,500 on the Dow. And I think the Dow in this final bubble, I think we're in the final phase, and I think it's going to go to something like 33,000 by later this year. I mean, because bubbles are progressive. So this last wave up, which I think started in December, that could take it to 33,000, then it could go to 5,500 or even 3,800. There's another thing we mark, the bubble origin. Bubbles tend to burst back to where they started. If you go back to the late 94 origin of this stock bubble, you'd have to go to 3,800. So 3,800.
And Harry, we need to take a commercial break for just a minute. Sorry to interrupt. We'll finish that thought when we come back. Stay with us. We'll be back with more here on The Income Generation. I'm David Scranton. We're with Harry Dent. We'll be right back.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes. David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
As we mentioned earlier, investment newsletters first rose to prominence in the 1980s during the best bull market in U.S. history. And Wall Street was being glamorized in things like movies, for example, as well as much of the other types of media. Investors from all walks of life were sure they could be the next Gordon Gekko, or maybe in real life, the next Donald Trump, whose book, The Art of the Deal, was a bestseller in 1987. What's more, it was around the same time that 401ks really began to replace most traditional pension plans. And as a result, many people came to think of the stock market as investing, not as gambling, but as a conventional investment strategy in which they had a fair amount of control. Now, while that mindset was less risky at that time, because during a long-term secular bull market, of course, the market goes up most years, but it was still risky nonetheless and misguided for many people. But in today's market, that is a truth that's more accurate than ever before. The truth is, there is a fundamental difference between everyday Americans trying to save for retirement and well-known big investors, those like, for example, Warren Buffett. The problem with investment newsletters is that they don't acknowledge this difference. In fact, some actually promote the idea that you, too, can be as successful as Warren Buffett if you just follow their advice and you pick the right stocks at the right time. But here's why that is wrong. When Warren Buffett invests in a company, he's generally buying a controlling share, and this gives him a level of control over that company's fate. By contrast, the average investor is buying a minority interest, which gives him no such control. He's putting money into a company in the mere hope that it succeeds. As a result, compared to Warren Buffett, what the average investor is doing is really more like gambling, not investing. Here's an analogy I've used before to explain this difference a bit further. As a sports fan, if I were to go on FanDuel and I were to place a bet, let's say on the Dallas Cowboys, to win their game on Sunday, my goals would be aligned with those of Jerry Jones, the team's owner. Why? Because if the Cowboys win, we both make money. But you know, that's where the similarities end. Because, you see, I have no control over the team, but Jerry Jones does. He's hired the coaches, the players, and may even, because he's so hands-on, may even have a say in strategy. You see, he is, in the realest sense of the word, investing in the team. But what I'm doing is I'm just gambling on it in the same way that I'm gambling on the stock market if I buy minority shares. Warren Buffett, on the other hand, is buying, in many cases, controlling shares and therefore is not gambling. He actually is investing. Now, the value of control and how a lack of it works against everyday stock market investors becomes even more obvious when you consider the pricing paradox. So let's say you have a business and decide to sell it. If the business is worth $1 million, you should be able to sell 49% of it for $490,000 or sell a majority, 51%, for $510,000. But that's not how it works in real life. In the real world, you'd be lucky to get $350,000 for the 49%. But you could ask for potentially as much as $650,000 for the 51%. So why can you ask for almost double for additional 2% ownership? The answer is control. See, the 51% gives the buyer controlling interest. So as a seller on the open market, you must discount the minority interest. But you can demand a premium for the controlling interest. And this explains the paradox, which goes like this. Why is it that when one publicly traded company makes a tender offer to buy a majority share of another, they typically come in with an offer that's only maybe 5 or 10% over the current price per share, as opposed to an offer that's almost double? Well, in my mind, if they're buying controlling interest, there's only two possible scenarios. Either number one, the board of directors of the selling company is willing to accept too little from the buyer. Or number two, average investors are overpaying for that company every single day when they're out calling the broker, their investment advisor, and buying minority interest shares. And somehow, I doubt that any board of directors is going to be as charitable as scenario one. I think the real answer is obvious, that the discount for minority shares is not priced into the market. What does this mean for you? This means that by definition, everyday investors are always overpaying for stocks on the open market. That's another thing most investment newsletters conveniently are not likely to mention. Now, some of you might be thinking, well, none of this applies to me because I'm not picking individual stocks based upon newsletter tips. I'm investing in my 401k in a mutual fund that's being managed. Well, in a way, that can be seen as even a greater gamble. You see, not only are you now betting that the company's managers for the particular stocks in that mutual fund are doing a good job, but you're also betting that your fund manager is doing a good job picking the right companies. So you've just introduced a whole second variable. So what is the alternative to all this gambling if you're not Warren Buffett? Well, I can't give that to you right now. You have to wait till after the commercial break, and we'll be talking about that in just a bit. Now we're to bring it back in our guest Harry Dent for one last segment. Harry is the author of the book 0 Hour and the editor of the free newsletter, Economy and Markets, which you can review by going to harrydent.com. Harry, thanks for sticking us around. Sorry to have cut you off, but you're talking about Dow as low as 3,800?
Yes, and probably by 2022, we have three big long-term cycles that all come together between 2020 and 2022. The economy tends to bottom maybe a year after that. So 2020 to 23 is the danger zone. And late this year is when this major bubble, the biggest bubble of all time, the most global, the most steep, is likely to peak. And at the latest, 1 year after that, if Trump can keep the economy going by sending free money in the mail.
Okay. So you're basically saying maybe we have 10, maybe 20% on the upside over the next
I think
six
more
to
than
18
that.
months?
I'm looking at a 10,000 NASDAQ and 33,000 Dow. So it's even more than that for the NASDAQ. And it's way more than that if you go from the December low where we started to tell people. We call it the dark window. It's the last rally just before the big crash. The best of the rally, then the worst of the crash, right next to each other.
That's a huge blow off, but then the drop to be as severe. So it's interesting. I've always said we have to go below 1,500 on the S&P, and very well can break through the 666 from the S&P we saw March 9, 2009.
That would be the minimum, 666.
You're calling even a bigger bear market. So in the last minute we have left, tell our income generation members, those over the age of 50, layman's advice, what does this mean to them in terms of how they should invest their hard-earned retirement dollars?
Well, you know one thing, I mean, later this year is the danger zone, especially if we get near that NASDAQ 10,000. You can either start, selling stocks, or you can hedge. If people don't realize, in a bubble like this, when there's so much upside and very little correction, options to hedge. You can go to your financial advisor and hedge your stock portfolio and not have to sell them and pay taxes and worry about missing the bubble. And only can cost like as low as 3% to insure. But the major point is, in a bubble burst like this, everything goes down. There's nowhere to hide. High quality bonds, 10 and 30-year treasury bonds, and the US dollar bonds will do the best. And that's what happened in 2008 and 9. Everything went down, the dollar went up, and high quality bonds went up, and gold and silver went down as well. So gold and silver is not going to save you.
No, I agree. Gold and silver doesn't produce any income. At least high-quality bonds do. Stay away from junk bonds at that point. Stay out of the market.
Junk bonds trade like stocks in a downturn.
Of course they do.
Junk bonds are the worst place to be. The money goes to highest quality bond and highest quality currencies. That's exactly what happened in the 30s, and that's exactly what we see happening here.
Harry, some good words of wisdom. I love it. Thanks so much for being back on the show. We really appreciate it. And you stay with us. We'll be back here with more on the income generation. I'm David Scranton, and we'll be right back.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes. David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
If you've ever played the ponies or bet on sports, you know there are plenty of blogs and websites and newsletters out there claiming to tell you how you can beat the odds. Well, to a certain degree, most investment newsletters that focus on things like hot tips, picking winners, timing the market, can't miss stock strategies really aren't much different from sports betting newsletters. The ones geared toward big money institutional investors might arguably be seen as offering advice on legitimate investment strategies. Why? Because those big investors can afford to purchase majority shares that give them a level of control. But the more affordable ones, the ones geared toward do-it-yourselfers, making individual stock trades in most cases, I believe they're promoting a practice that's really more like gambling for everyday investors, which is especially risky for investors who are retired or within 10 years of retirement, members of the income generation. But here's the good news. Despite the continued popularity of investment newsletters and the continued popularity of the financial media's obsession with Wall Street, there are options beyond the stock market that do offer everyday investors a level of control. That makes these options legitimate, strategic investments, much more so than high-risk gambles, which is probably why you won't ever read about them in an investment newsletter. They're not flashy enough, and they're definitely not simple enough for a newsletter writer to explain how to implement to a do-it-yourselfer, especially a writer with limited financial credentials, which is often the case. Now, naturally, I'm talking about conservative investment options geared toward portfolio protection and reliable income. And that means conservative in the financial sense, not the political sense. It means strategies designed to dramatically reduce your risk of loss due to market volatility and principal spend down, but also those that are designed to generate income through the form of interest and dividends at a competitive rate. Now, that income is income that you can spend to meet your specific needs and goals now, or you can reinvest that income in other conservative strategies for the future and grow your portfolio organically. Now, what makes these legitimate investment strategies rather than risky market gambles is the fact that most are contract-based. That gives you that all-important element of control, the same advantage that majority shareholders have in the stock market, but everyday investors typically don't. The easy example I share most often is individual bonds. When you purchase an individual bond, it comes with a contract providing two guarantees, in fact, that you don't get with a bond mutual fund. Why? Because that bond mutual fund is technically defined as the stock of a company that owns bonds. Those guarantees are as follows. First, income generation at a fixed rate for the life of the bond. And second, return of principal if you hold the bond to maturity. And of course, there's no default. Now, naturally, no investment is 100% risk-free. But there is a big difference between a legitimate investment strategy designed by an investment manager to lower your risk and versus the kinds of hot tip, high risk, do-it-yourself market gambles that are touted by many so-called investment newsletters. Now that's where I want to bring in our next guest, Adam Sharp. Adam is one of the founders of Early Investing, a website and newsletter that helps people invest in private startups. He also writes the monthly research service, First Stage Investor, and he's a former financial advisor. Adam, thanks so much for being here today.
Thanks for having me.
So, people who write newsletters come from all different backgrounds. You're a financial advisor. There's some that are economists, some that are academics. Why do you think it's an advantage with you being a financial advisor, a former financial advisor, writing a newsletter over some of those others?
Yeah, it certainly gives you, just a foundational understanding of how markets work. How stocks are priced, all the stuff that, we learned getting our Series 7s and 66s. But, I actually wasn't in the industry very long, so I don't have a ton of work experience there. It was kind of a bad work experience for me. And we actually don't focus mostly on stock markets, but, I do follow it very closely.
So, okay, so you know that, knowing the psychology of an investor because you worked directly with them in the past, in a short period, but nonetheless you did. Tell us, investors want, before they act on a newsletter, they want to try it before they buy it. Any advice for that person that wants to sample it, wants to try some things, wants to maybe paper trade? What do you tell that person?
Yeah, you really need to do your research before you select a newsletter. It's very important that, you really want to choose somebody that's very transparent with their numbers. If there's anything that looks suspicious with the charts or it looks like they're cherry picking the numbers, you want to dig into all this stuff and make sure that it's all legit. And ask your friends what's working for them. If you have friends that are in the industry, there's really nothing better than what's working right now. But you do want to do a lot of research on, any newsletter that you purchase. For sure. It's an important step that you have to take.
Sure. We talked earlier in the show, as you heard, that a lot of newsletters are no longer in business because their advice just wasn't beneficial. So eventually they couldn't sell newsletters anymore. We need to take a quick commercial break though, Adam. Please stay with us, and you stay with us too. We'll be here with more on the income generation. I'm Dave Scranton, and we'll be right back. Welcome back. We're here talking with Adam Sharp, the co-founder of Early Investing, a website and newsletter that helps people invest in private startup companies. Adam is also a former financial advisor with extensive experience in internet marketing and financial writing. Adam, thanks for sticking around.
Thanks for having me.
So, okay, I know you're dealing with startup companies, so this next issue I'm going to mention doesn't really apply to people getting your newsletter, but applies to a lot of other newsletters. So I want your feedback on this. How do you protect yourself? How does one protect themselves when trying to trade from a newsletter to make sure that they're not being the laggard? In other words, of all the hundreds or thousands of people in the newsletter, they're all making the trades first and you're the last guy in, and therefore whatever beneficial information was there is now useless to you because you didn't act quick enough. How can an investor protect him or herself from that type of thing?
I think the best way to avoid that type of situation is, any newsletter you're reading that's recommending anything that's small enough that it's getting pushed around by its readers. You got to take a step back at that point and be a little bit cautious, because a lot of people do illicit stuff with newsletters. Any small stock, essentially, if it's small enough that it could get moved by the newsletter readership. That's kind of a red flag. It's a little bit of a warning sign. Most people stick to stuff that's big enough that it's not going to move significantly on just a newsletter recommendation. But it's all the things it's part of the things you want to do when you're researching a newsletter. Look at what their recommendations look like. Are they big, reputable companies? Are they tiny, kind of weird looking companies?
And of course, the smaller companies can be moved in the market with smaller dollar amounts. I completely get that. So now you're doing startups primarily. So in talking about startups, recommending startups, tell us, is that an advantage where are there fewer newsletter players, if you will, in that field? Is that part of what made that attractive to you?
Yeah, so there's certainly less competition. So we deal with private startups, which were enabled by some legislation a couple years ago. That's a long story. I'm not going to tell it. But basically, anyone can invest in private early stage startups. These companies are valued anywhere from $2 to $10 million usually. And you can invest $50, $100 in these things. So it's pretty neat. It's kind of a different thing, and it does differentiate us from all the other stock newsletters out there.
So 20 seconds left. How do you tell the average investor, though, not to try to bet the ranch, who's somebody who's retired or close to retirement, betting too much money on these types of things? How do you warn them to keep it reasonable?
Yeah, so we do alternative assets. We tell people, if you're talking cryptocurrency, 1 to 3%, startups, no more than 10%, gold, silver, stuff like that, maybe 5, 10%. So we just tell people to keep your allocations reasonable. Don't bet too much on anything that's risky, and don't bet anything you're not willing to lose.
Well, Adam, that's what I love about you. You do it the right way. Thanks so much for being on the show today.
Thank you.
Stick with us. We'll be right back with more on the income generation. We'll be right back. I'd like to thank both of our guests for joining us today for another episode of the Income Generation. But I also like to thank you, our new and returning viewers.
Oh, the great Oz has spoken. Oh, pay no attention to that man behind the curtain.
Of course, we all remember that climactic scene from The Wizard of Oz. After putting all their faith in the wisdom and guidance of the wonderful wizard, Dorothy and her friends discovered that he's really not what he appears to be. Behind the curtain, he's just a man who puts on a really good show. Here's the reality. Many investment newsletters are either designed mainly to put on a good show and sell subscriptions, or they're geared toward the kinds of investors who have some level of strategic control when they invest in the stock market. Most everyday investors simply don't have that kind of control and can only really get it, in my experience, through conservative, non-stock market, income-generating financial strategies. Here's another way to think about the difference. When buying a stock, you actually have to do 3 things right in order for the purchase to pay off, all of which involves some guesswork. First, you have to buy the stock correctly, then it has to go up in value, and then you have to sell it correctly. Now, by comparison, when you buy an individual bond or a bond-like instrument, you really only have to do the first thing, is buy it correctly. If you do that, ideally with the help of an advisor who specializes in income-generating alternatives, your investment will pay off in the way it was designed to, and you have a contract assuring you of that. Now, it may not always pay off to the same extent that your stock might if you do all three things right, but you also run far less risk of losing money. And again, absolutely no investment is completely guaranteed. And let's face it, everything in life is a bit of a gamble. But consider this. Imagine that you're at the casino and there are two slot machines. The first machine pays where you could win a big jackpot if you hit triple sevens, but pays you nothing if you hit anything else. The other machine pays a smaller jackpot for triple sevens, but also pays you something no matter what you hit. Which of these two machines would you be more likely to play? In my experience, most people see the sense in choosing the second machine, which of course represents contractual, income-based investment strategies. But even if you think you might choose the big jackpot or nothing option, ask yourself this. What if the money you were gambling with was your entire life savings? Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date, and right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.